Let's now look at equilibrium. Equilibrium in this market, the nominal money market, is going to be balancing the supply side with the demand side. We have both those pieces, so demand in this market, we know the demand for nominal money depends on real GDP, the price level, the nominal interest rate, and the expected future nominal interest rate. If real GDP goes up, money demand goes up. If the price level goes up, money demand goes up, so I put little pluses. But if the interest rate goes up, money demand falls. And if the future interest rates are expected to rise, it can increase money demand today. We're going to graph in quantity of money and interest rate space, so that means these other factors are all available to shift the curve around. The supply side is much more simple. It is basically the quantity of money put out into the market exogenously by some government agency, depending on the economy you live in. So those are our two pieces. We graphed each. Money demand looks like this. And money supply looks like this. Very simple. If you notice, the interest rate is the same, but this piece is a little different. It's still the quantity of money, but here I was calling it money demand, and here I was calling it money supplied. When we're in equilibrium, those two will be equal, and we'll just call it the quantity of money in the economy. So combining these two gets us a graph that looks like this. And that graph determines the market equilibrium interest rate and the total amount of money in the market. Trivially, the amount of money is determined by the supply of money, right? There's only so many dollar bills they put out into an economy. That's sort of fixed. So really, this market is determining the nominal interest rate. We use this most commonly to analyze the effect of monetary policy on the interest rate or the effect of shocks to the economy through money demand on the interest rate. And in more complex scenarios, we can think about monetary policy in this market and the interaction between interest rates and the money supply and eventually the exchange rate and so on. But this is the basic analysis. So let's look real quickly at this equilibrium interest rate that's going to clear the market and why it works. So let's imagine an interest rate that is higher than the market clearing interest rate. If this were true, we would have a graph that looks like this. This would be money supply, and this would be money demand. And instead of being here, the interest rate would be up here. Why would it eventually fall back to here to the equilibrium interest rate? Well, at a higher interest rate, money demand is here, and money supply is here. So this means there's more money on the market than people are demanding. This means banks don't need to offer such a high interest rate to convince people to put deposits with them. As a result, banks will begin to lower the interest rate they're paying on savings. And we know as your savings and investment accounts pay less, you move more of your money back into the demand side. So slowly but surely, interest rates would fall down and you would move back to this equilibrium rate. The opposite happens if the interest rate is below the market clearing rate. If this is the market clearing rate and interest rates happen to be down here for some reason, money demand is higher than money supply at that interest rate. There's a shortage of money on the market, and banks now have to start also offering higher interest rates to get people to leave their deposits with them. Everybody wants cash to be spent. So everyone's pulling their money out of their banks, and the banks panic and start raising the interest rates, trying to get people to leave their deposits in there. As that rises, it pulls everything back to this equilibrium interest rate. So that is the equilibrium interest rate. It's the one that we say clears the market, so there's no shortage or surplus. And this is the basic diagram we'll use to look at equilibrium in the nominal money market.